Well, we're now looking at precious metals, and depending on how you see the market reaction to the current economic climate, it may steer you towards this area for investment, which is so often referred to as a safe haven away from volatility and inflation. Joining us now is Eric Strand. He's a portfolio manager at the AuAg funds in Stockholm. Eric, thanks indeed for your time. First of all, how should we view gold and silver at the moment in the current economic part of the economic cycle?
Well, first of all, nice to be here, Jeremy. I mean, gold has and silver has different properties if it's about defending a portfolio and it's a very volatile market. But I mean, that's something that goes up for short term and then comes back. But what is important is the monetary inflation that we have going since the last years, the money printing, and that is what's really driving the gold price. And of course, when there is something happening in the system, if it has been the war or now other things happening in the bank crisis, goes up from that as well. But in the end, it's all about the money printing in the system.
Well, we've seen a lot of money printing, of course, in the system, and we have seen record highs for gold. But those that think there's better places to put the money always go back to this same point, that gold doesn't pay a dividend. It doesn't give you any return. You just hold it and then sell it when you want to sell it. How do you get around that when you're talking to investors about investing in the precious metals space? What do you say to them about how to get returns out of investing in precious metals?
Well, I think that is also the definition of gold. It should have no dividends because you don't have any counterparty risks. I mean, when you have counterparty risk, that's why you get dividends or returns from the bank or whatever. You don't have the counterparty risk, so you don't have that interest on gold. So it fills its function. But of course, I mean, we are printing so much money that gold goes up. Gold is actually the constant. It's the fiat currencies, if it's the euro, pound, or dollar, that actually goes down compared to gold. So you will get the returns there. But you are right. You can also go to the miners because the miners are equity and they actually have really high dividends today. Around many have 4% dividend, 5% dividend because they have really good balance sheets, very good cash flow. So the miners is actually a dividend play as well.
And of course, we hear that gold perhaps maybe doesn't have as many uses as silver. Is silver a better play, or is gold a better play at the moment? Or do they run side by side in times of economic stress? Do they both go up together, or do they go up in sort of different dynamics?
Well, I do really like gold, but I'm actually in love with silver. Silver is an amazing metal because it has both parts. Gold is used, like 10% of all mined gold is used for high tech, and we need that high tech for everything, so we cannot be without that gold. But silver is like 50% investment, 50% industrial use, and it's used in so many places. It's like the second most used commodity after oil in different applications, and it's everywhere. And what is interesting is that you only need very little silver in everything, if it's the car, mobile phone, or sun cells, but you need it because it's the best metal to lead electricity and heat in this transformation to electrification in the world. And when you don't need so much, but you need it, the price becomes inelastic. That means even if the price of silver doubles or triples, you use so little in a car, so the price of the car doesn't change. So the producers of the cars, they need the silver. They pay anything because without it, they can't do the car. And that makes a really interesting development for the price of silver, this inelasticity, and that we don't have any reserves. It gets really tight. So we do think that the big car producers, soon they will start to buy more silver just to have in case, so they don't run out of it, because if you don't have it, you cannot produce many things.
Yeah. How much of in the price is the scarcity of the metal coming out of the ground? I mean, we never know where the next big mine's going to come from and how lucrative it's going to be. So it's always very difficult to tell just what's around the corner. But what are we looking at in terms of demand and supply here? We've been talking about the availability of this investment to give us some stability, some grounding, some of the the market away from volatility. But is there a play on here because there is insufficient amount of metal coming out of the ground?
Yeah, well, of course, in gold, all gold that has been mined is there because nobody throws gold away because it's so valuable. So there you have a lot of gold. But probably, or the thing is, who wants to sell it at what price? In silver, there is very close to physical shortage. And if you have a physical shortage in the commodity space, the prices, they go really fast. And we think we are there in silver. In gold, it will not be that fast, but still, there has been so much money printing, and gold has had some headwinds because of the strong dollar, the Fed hiking rates really fast. Still, gold has been strong, and now after the banking crisis, we see the Fed has to reverse their QT. They're now back almost where they started the QT. So. And the market doesn't expect much more of rate hikes in the US. So that gets really, really interesting for gold to have a lot of tailwinds, to have a lot of speed forward. So now it looks really, really good. So now is a good time.
How do you recommend an investor goes about getting exposure? I mean, you've got your ETF. So let's talk a little bit about how they give exposure to the market. Your gold fund seems to be mostly, if not all, in equities, but there's also other options, aren't there, to invest in this space, like bullion, like sovereigns or currency. What do you recommend, and how does one go about constructing a good, solid portfolio of precious metals investments?
Well, we are a bit hardcore physical, so I always think you should have some gold and silver at home, or maybe if not at home, very close to your home, or somewhere where only you can get to it. So, but that doesn't have to be so much. But you should have the coins, especially silver coins, if there is the really, really bad situation in the world. But hopefully you won't need it. It's like the insurance of your house. But if you want to invest larger amounts of money on your platform, I think you can have the bullion bar or a straight gold commodity. We have that with the Han ETF. There is the RMAU, the Royal Mint, 1-to-1 gold. And then it's, of course, our ETF, where we have the miners instead. So if you play precious metals for safety, I would recommend the ETF, or ETC, it's called, with just gold in it. But if you start to like, okay, this is a place where we can get some returns, it has very low correlation with the normal equity market, then the miners, of course, are much more interesting. So it depends a little bit where you want to go with the investment.
Yeah, let's look at a couple of charts just to remind ourselves as to the compare and contrast between what's happened with gold and what's happened with silver. I want to break up a gold chart first of all. You'll be familiar with this. We're not too far away at the moment in terms of dollar value at $2,000, and you can see if you look at this, I mean, it goes back to the middle of the chart here, back to August 2011 when we had that record high there, and of course that was surpassed by the record high going back to August 2020. Since then, it's not been too far away from the top, and indeed this recent rally has taken us up, as I said, to that 2000 level. But if you look at silver, it's a very different sort of chart where you've got this big pullback from the highs that we had back in April 2011 all the way up at $49.82 per troy ounce. Here we are now at 24.04. And I know that you, as a specialist in the gold and silver area, you look at this thing about the gold to silver ratio. What does the ratio tell us? It's currently 82. That means if you divide the amount of the cost of an ounce of gold by the ounce of silver, you get it to 82. What's that telling us at the moment?
The short answer is that silver is cheap. So, and that would be a better investment if you believe that we will see a secular bull market for precious metals. In historical bull markets for precious metals, the ratio would go down to 30-1 approximately. And then it's good to know the natural occurrence in Earth is 16-1. And that was the price that Sir Isaac Newton set as well, 16-1, which means silver has a lot of room to go up. I think this one, if we have a really strong bull market, it could go down to 10-1 even. But we will start to think about 30-1. But 10-1 is possible because this physical shortage of silver and silver has these, as I said, properties for electricity and heat that no other metal has in the world. So I think we will see a new record on that purpose. But now, so it's 82 to 1. Then silver is cheap, and when it comes down to 30 to 1 or 20 to 1, then maybe you should sell the silver and buy the gold. But at this moment, silver and miners is the most interesting if you look at the return.
Okay, well let's take what you've just said and assume that we're going to get this bull market. I want to bring back the gold chart because it's nice round numbers. We're at 2,000. You're talking about 30 to 1, possibly 10 to 1. And you say silver is relatively cheap compared to gold at the moment. So you're talking about a big incremental increase proportionately than gold. Here we are, gold at 2,000. How far up in a bull market are you expecting both these precious metals to go? What, to keep that ratio that you're now looking at, what are your levels of expectation in times of stress or strain in the market?
We are expecting a new all-time high in gold in US dollars. We see it already in a lot of different currencies, but not in the US dollar, as it has been rather strong, not the last months, but before that. And we will pass. We are now really, really close to the 2,000 again, has been the last period of the weeks. And when we go through that, and when we go through 2,100, it will just go up a lot. So up until 2,100, there will be some struggle there. But when we pass 2,100, we will continue. And for the year, we would expect a 20% return in gold in US dollars. But we also think that the US dollar will lose value towards the euro or pound, maybe let's say 10%. And that would mean a European investor would only get 10% of net return, even if the gold price in dollars up 20%. And this is where it makes interesting with the miners, because the miners are normally a leverage play on gold. Let's say it goes up twice or go down twice. That's just an example. If gold goes up 20%, the miners would go up 40%. And what happens is this leverage happens before the FX change. So this minus 10% you lose on the FX, the currencies, would give you a net of 30%. Compared to the 10%. So it would be a 3-time leverage for a European investor. In the US, it would just be the 2-time leverage. But for a European investor, this year, where we may see a weaker dollar. And why do we see a weaker dollar? Because the Fed raised their rates before everybody else. That made the US dollar so strong. Now they are there. They can't raise it, if they maybe a little bit, but it's like 25 basis points. And we think the ECB will have to raise rates a little bit more. That means the euro will get stronger and the pound may get stronger, and that's why you may lose on the dollar this year, and that makes the mining or miner investment really, really interesting this year.
And of course, this all goes hand in hand with this idea that when you get that leveraged incremental increase in the price of gold, you're getting more profits. That's assuming, of course, that costs don't go up per ounce to get the gold out of the ground. But nonetheless, I get your point, and it is a point that's well made. If we do see that rise in gold, and it passes that 2,100, and then easily drifts on to what, 3,000? I mean, have you got a number in mind? It's difficult to talk about numbers just out of the air, but do you have a sort of a figure that you are working to?
Well, I mean, we are long only, so we won't leave the space even if it goes too far.
Right.
And in a secular bull market, one day it will go up too much or more than it should. But we actually view gold below 3,000 as cheap because, and the reason to that is that there's so much money printed, so much debt created, and every time we see the central bank or the Fed try to make a QT, they've tried that 4 times, and every time they resort to the same thing, and that is to print more money, create more debt. I mean, we had a debt crisis 2008, and now we have more than twice the amount of debt. So we never solved the problem. And I think for politicians and so on, the easy way out is always to create more debt and more money, and that will continue. So we see the prices go up a lot in the future, and the real bull market, the real secular bull market will start now.
Right. Okay. So going back to this gold to silver ratio, if you say gold under 3,000 is cheap, let's just say there's a target of 3,000. That takes silver up from, look at this chart here, 2405 up to what, $100 an ounce. Correct.
Yeah. With 30 to
So
1, we would be
that
at
gives you,
a triple digit silver at 100. And so that would mean we would have a 300% return in silver, where there's a 50% return in gold. And I think that's proportion is interesting. Then if gold only goes up 25%, still silver may make 3 times that percentage. So silver is really, really interesting. But of course, it's a volatile commodity. It's a smaller market, so you really have to buckle up and not you have to have strong nerves because it goes up and down really fast, and you cannot really wait for it because when it goes up really, really fast.
okay, we've spoken about your gold portfolio. What about the silver? Are you heavily into stocks in the silver sector as well, or are you spread across other sort of assets within the silver space?
No, we have our daily usage fund is focusing on silver miners, and you really try to get the primary silver miners because sometimes silver is a byproduct and you don't really want that miner, so you really try to find as much silver as possible. Of course, no miner is just mining one commodity. I mean, if you find gold, you take the gold up as well, and every deposit has both gold and silver, so there is no pure. You just have to have the focus on miners that have more silver or more gold, actually.
Okay, look, it's a fascinating chat. Thanks indeed for your time, Eric. It's been a pleasure catching up with you and finding out more about your portfolio investments. Thanks for joining us. That's Eric Strand. He's portfolio manager at AuAg Funds.